Most people are looking at our current economic numbers here in America and are easily thinking that everything is all good right now. But I want you to just pay attention. There are some potential problems going on that I want you to be aware of. This video right here, it's not to scare you. It's not to make you panic, but you need to be aware, and that's what I want to do in this video. Get you to pay attention to what's going on around you. Guys, right now, the stock market is at all-time highs again. We just hit another all-time high on this past Friday a couple days ago. Now, right now, we also know that the unemployment rate is around 4.3%. Then we have the U.S. economy that just reported 2% annualized GDP growth for the first quarter of this year. Not to mention, oil is currently trading around $70 to $75 per barrel, which is down from earlier highs this year and well below the $100 per barrel levels. And the Federal Reserve just last week decided to keep the Fed funds rate steady at between 3.5% and 3.75%, right? And so they froze the rates last week and didn't change them. On top of that, the Federal Reserve Chair, Jerome Powell, decided to stay on as a governor, which signals or supposed to signal some type of continuity in leadership, right? Again, another sign that everything appears supposedly stable in our economy. So when you look at all of those things together, everything looks good on the surface. And that's the problem that I want you to be aware of, because nothing in those numbers tell you to be cautious. And that's exactly why you need to be cautious and a little bit skeptical and prepared. This is the type of environment right now where people stop preparing and they start assuming that, oh, it's all good. Our economy is great. Look, we just got that report and that report, right? And everything is gravy. I don't want you to assume that everything is fine and everything is perfect, because that will make you let your guard down. Okay, and you don't want to let your guard down. What matters here, guys, is not just all of these numbers look positive. What really matters is that they're all positive at the same time. That should make you wonder. All of this combined with a strong stock market that continues to go up higher and higher. So here's the deal. Nothing feels urgent. And when urgency disappears, sometimes our discipline usually goes with it. Now, notice something. I'm not saying panic. I'm saying it's okay to have a sense of urgency so you don't fall asleep and get into this idea, this notion that everything is great. Because here's the deal. Most people don't follow a simple system. They just follow how they feel. And if they can make you feel good about the economy, you chillin'. Don't chill. Right now, things feel wonderful based on all the information that we're getting about the economy right now. But is that just a smokescreen? Is that just politics trying to make us all feel good at the same time, right? Let me know your thoughts about that in the comments below. Is the economy really doing as well as they're telling us in these numbers? See, here's the problem. When everything looks good on the surface, people just kind of slow down with their thought processes in terms of what they're trying to do financially. People stop preparing. People stop reviewing their investments. People stop thinking about something as important as risk. And you should always be considering risk when you're dealing with your personal finances and you're looking at the larger economy. What happens is people stop asking the right questions. Like, if something changes, am I ready? Are my finances prepared? Do I have enough cash? These are the questions that people sort of stop asking themselves. And what happens is we replace those important questions with, oh, I'm good. Oh, everything's fine. Everything's going great. And the dangerous part is this, okay? You don't feel like you're making a mistake when all of this is happening and everything's wonderful. Nothing feels wrong. You don't get no type of warning sign through the media when the media is telling us that all the numbers look good on the surface, right? So what happens is you sort of slowly move away from any sort of real structure and plans that you might have with your money. And that's the shift where people can tend to make mistakes. Mistakes as a consumer, mistakes as an investor, all that. Now, I mentioned something earlier that I want to dig a little deeper into, right? It's the GDP that just came out a few days ago, right? Because this matters. And so I wanted to hit on it for just a moment. GDP, guys, stands for Gross Domestic Product. It's one of those economic terms you might have had back in high school that you sort of forgot about. but it's really important. It simply means this. GDP is the total end value of everything produced in our economy in a certain period of time. And that certain period of time is usually measured in quarters. So that's the total of goods and services and all that combined every quarter. If GDP, here's the deal, if GDP is going up real fast, the economy is thought to be growing, right? If GDP is going up slowly or it's negative, the economy is thought to be slowing down or going backward. Now, here's the important thing about GDP. We don't get just one GDP number. We get 3 readings every single quarter. Okay? The first reading is what's called an advance estimate. It's the first report. And we just got our first report for the first quarter. And so that was January, February, and March. We get the first report from that first quarter in April, at the end of April. So we got the advanced estimate or the first reading for April, and it said the GDP is going up at 2% in the first quarter of this year, which is pretty good, right? Now, the second estimate is updated and it's more complete data. Now, we're going to get that second estimate of the first quarter GDP in late May. And then in June, we're going to get the final estimate of the first quarter of this year. And it's going to be the most accurate version, right? We won't get the final estimate for the first quarter until late June. Now, why does this happen? Why are we waiting till June to get the final numbers from January, February, March, first quarter? Because the government doesn't have all the data immediately. The data sort of trickles in. Businesses, they report the data at different times. Economic activity is always measured in stages, right? So the first number that we just got for the first quarter ending March 31st is based on pretty much incomplete information. Right now, it's saying 2% GDP, but those GDP numbers do change, okay? Sometimes they change a little bit. Sometimes they change in a more meaningful way. So when you heard the recent GDP headline, you're hearing an early estimate, not a final answer of what the GDP was for the first quarter of this year. Now, I wanted to point that out because you're not going to hear that on the 5 o'clock news or the 6 o'clock news or the 10 o'clock news or CNN. They're not going to stress that to you, but it's important that we know that so we don't look at that number and all of a sudden say, oh yeah, everything's fantastic. GDP is going up, right? Remember, that number is going to change. And here's the deal. The stock market that most of us are invested in, it's always looking forward, not backwards, right? So the stock market is always reacting to expectations in the future, not just the confirmed data, because the data always suffers some lag time. Again, we won't know the full right data for first quarter 2026 until late June. So if the GDP number changes, it can shift how investors see the future economy, right? Now, the 2% GDP growth is decent. Like I said, right? It's pretty steady. And steady growth combined with steady markets, like I mentioned earlier, creates comfort. Sometimes too much comfort if you believe the numbers. And here's the deal. Comfort is what I'm really talking about in this whole video, that you have to be careful about becoming too comfortable based on the numbers that you're seeing from the media, right? So now step back and look at the full picture in our economy. Stocks at record highs, GDP growing at 2%, unemployment pretty stable at around 4.3%, fairly low, right, historically. Interest rates steady between 3.5%, 3.75%. Inflation, which I didn't mention earlier, sort of going up a little bit, but still holding steady around 3%. All of that sounds okay. It sounds decent on paper. It sounds like, okay, things are pretty good. But none of this means that risk is gone. It simply means that the risk is harder for us to see. The problem with the economy is being hidden behind good numbers. And when this risk is harder to see and we have all these great numbers, people stop looking for the issues. People stop paying attention to the problems. And this is where people make small changes that can matter in a big way if you're not careful. When they show these great numbers, what they're doing is they're normalizing things in a way where we have sort of short memories. It's so easy sometimes to manipulate us because the media is so powerful. It was just 3 or 4 years ago, guys, that we had record inflation. And that record inflation didn't just go away, it got normalized into our everyday spending. And all these good numbers sort of make us forget about the fact that rents are incredibly high. The cost of insurance is incredibly high. The cost of food is incredibly high because things got normalized. And they help them get normalized with all these good numbers. So what happens in people's financial lives is we stop doing the things that matter, like, rebalancing our portfolios, or we don't take a step back and recalibrate our monthly budget and redo our expenses so they come down and they don't keep going up and up. We stop holding enough cash, right? And we stop reviewing our plans on a regular basis. And all that happens not because everybody is just out here being reckless. I believe that most people are not being reckless with their money, but we stop doing all those things because everything feels stable and normal. Sounds good, looks good, and high prices are just normal. High taxes, just normal. High debt is just normal. And the propaganda lulls us to sleep. And I'm saying in this video, wake up and be prepared, okay? The biggest investing mistakes don't happen when things are bad. The biggest investing mistakes and the biggest mistakes we make with our money happen when everything feels good, because that's when people stop respecting risk and people stop paying attention. Now, here's how to be prepared, because I don't like to leave a video ever without giving you some things to do. This is what be prepared actually means. Number one, stay consistent. Keep investing on your own schedule, according to your own structure or plan. You don't have to get all riled up and happy and hyped up because everything looks fine on paper. Remember, intelligent investing removes emotion. So don't change your investing behavior because the market feels strong. Be consistent. Consistency is what removes emotion from the equation. Second thing you can do is make sure you rebalance. If you have a structure that says, I want 80% in here and I want 20% in here, I want 40% in growth stocks and 60% in value stocks, you need to rebalance every now and then. It could be every year, could be every couple of years. But if we're looking at these all-time highs in the stock market, it's a possibility that your stock allocation or your ETF allocation or your index fund allocation has increased because of gains in the market. Bring them back to your target every so often, right? Because gains can quietly increase your risk without you knowing it if you don't rebalance. I'm not saying you have to rebalance every 2 months, but at least once a year or once every couple of years, consider it. The third thing is this: hold on to some liquidity. The cash is not going away. Having enough cash so you're not forced to sell investments when pressure does get tight or we see a lull in the market, right? Cash gives you flexibility when things shift and change. So have some. The fourth thing you want to think about is know your numbers and know where your money is going, right? Understand exactly where your money is headed. What do you have and where is it being directed and allocated towards? Especially when we're talking about these high growth sectors like tech. Consider your goals, what you're trying to accomplish. Consider your structure that you want to have in place to grow and build wealth, and make sure you don't have all your money in one basket. Diversify and allocate. And I don't care if you have $3,000 or you got $300,000. You can still diversify and allocate. Fifth thing you can do is reconfirm your system. You should be able to clearly explain what you invest in, how often you invest, how much you invest, why you invest, what is your core philosophy on investing. And these things may sound foreign to you, but you can develop all of these things. You can create a system that you manage your money by. If you can't explain where your money is going clearly, you probably don't have a system, and you need one. A system is what you're going to follow when your emotions are going to try to take over, either getting too hyped or getting too down. When you have a system in place, the system works no matter what your emotions are feeling, okay? The sixth thing is this: make sure you plan ahead. Here's an example. What do I do if the market drops by 10%? What do I do if the market drops by 20% in the next week? What do I do if inflation starts to go up crazy again and we go from 3% to 5% to 7%, right? What do I do if we have something similar happen like the pandemic? Or what if interest rates stay higher for longer and this new Fed chair coming in doesn't lower the interest rates like we thought he would, right? If you don't have answers before something happens, you're going to be forced to react. And you don't want to react because reacting draws on emotions. Listen, preparation is not comfort. It's what's going to protect you and your money and help your money grow, because comfort don't tell you what to do next. It really don't. It never does. But your system, a real system, will. The market being at all-time highs is not the issue here. The issue is how you're behaving right now when everything looks good. Look, most people think everything is good right now. That's the problem. Please be prepared. Look, if you're listening to this and you're realizing that you don't actually have a clear system or a plan for your money, that's what I focus on. I run a 30-day financial reset where we build your full financial structure, step by step, your budget, your accounts, your plan, your long-term investing, your thinking. Hey, if you're ready to get organized and take control of your money, you can join us. The link to the 4-step financial reset is in the description box below. If you got value from this video, do me a favor and drop me a comment below and just say, I got value, and share this video with someone who you think could use it. And remember this, guys, the absolute best person who's going to take care of the old you is the young you. Until the next video, peace.